Good evening, everyone, and welcome to another session of Small Talk Case by Case webinar. And today, Small Case is very lucky to have two guests who are very much experts in the field of investments. I would like to welcome Shyam Sundar and Kishan Nair on behalf of Flameback Capital. Guys, say hi.
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 Hi, everyone.
Hi. So we're really what we have the topic here for today is I think a lot of shrouded in mystery because it has the word magic in it. But I believe the strategy is something that has a lot to play with value investing and is definitely something that is delightfully magical. So we're all excited to know about this magic formula, how it came to be, and all about it. So thank you so much, guys, for coming on board. And over to you.
Yes, sir.
Hi, all. So before we dive into what magic formula is, let's take a step back and have a look at the big picture, right? So, broadly speaking, when you go about this whole investing game, so to speak, you have a choice to make initially. So, are you going to be a qualitative investor who is going to be paying attention to the stories, paying attention to what the management says, and just getting the general overall unstructured stuff in place and making investment decisions based on that? Or are you going to be driven by quantitative metrics that that are available through crunching numbers on the balance sheet or the income statements and so on? So this is the biggest choice in front of you, whether you are going to go qualitative or quantitative. It is not that once the choice is made, it is written in stone, because a lot can be gained by kind of mixing and matching different traits within these two universes. Um, but broadly speaking, if you look at quantitative investing, it is investing only looking at numbers. That's the strict definition of it. And those numbers are basically arrived at by slicing and dicing publicly available data that is being put out by the company or by the different industry associations that cover different aspects of of the universe of listed stocks. And the key thing there is what numbers are you going to look at, right? So are you going to look at price to book? Are you going to look at earnings momentum? Are you going to look at return on invested capital, and so on and so forth? So you basically pick one or a combination of different ratios or factors, as I call them, and see how you can mix them and match them together in a way that actually beats the market. So broadly speaking, you have qualitative, quantitative. Quantitative is only looking at numbers, and within the quantitative universe, you have quantitative value and quantitative momentum. Quantitative value investing is something that we're going to be discussing today, a variant of it called magic formula. The whole idea behind magic formula was put forth in a book which came out in 2005, and Kishan is going to dive into the details of magic formula investing as laid out in the book.
Yeah. Jesham, so I mean, I think most of us have read the book at some point. At least gone to the Amazon page and or like just search for it online, and go to gist of what the of what this particular strategy does. So when I joined my first job, the first book which I was asked to read was this. So so I actually found it fascinating because I just I mean I spent my time reading through balance sheets and financial statements and then you can meet probably 24 companies in a year. Like if you had to do justice to them, and then the universe, I mean, would be small, right? Because if you just limited yourself to those companies, uh, I mean, you would be I'm stuck with them, because you would have to choose between those companies, and not all the companies would be the ones that you would um, you know ideally like to invest in. But then that's your pool of I mean, that's a universe. So for me, um, when I found strategy, I thought, wow, this is like it's a shortcut. If I can get all the financial uh, like information, um, just by good money control, I can like put them in an Excel sheet, uh, spend a couple of nights doing that, and then have an easy formula, which takes probably 2 nights of work, like once a year. I have a strategy which works. Which is a extremely smart way of thinking. When you're like 21 or 2, or 22. So I think, I mean, most people, find strategy like intriguing because it seems easy enough. It also promises, extremely high returns. I think, when strategy, I mean, was tested out, it like outperformed the S&P 500 from a 15 to 16-year period, and it like outperformed it by 33%. I think. No, 20%. Which is pretty significant. And so you're like, oh wow, if this strategy works in the US, it should work in India, and then we will have, I mean, I have the best market-beating return, and I'll make my life, I mean, based out of this. So, uh, it changed the way the way you thought of investing from a more discretionary-based approach to more quantitative, like investing style. And I think most people, I mean, if you go to screener.com, the first screener that I see is Magic Formula. So it's quite popular in that sense that most people, their first association, I think, with quantitative investing comes from the Magic Formula. And I think over the years, people, what me and you try to prescribe is to have a more disciplined form of like investing, so you find the stocks which which most fit the criteria, say the top 20 or 30 or like 50 companies, and then you like invest in them and you just rebalance them once a year. I think many people have moved on from that, and use it as a like an idea screener, right? So you find these companies. So people have implemented it in like different ways. But I think for this talk, we'll use it in a more like, I mean, what the book prescribes. I think, I mean, sticking to the original, I mean, like formula. Uh, what is the magic formula? It is actually a pretty simple strategy which tries to combine the quality and value. Uh, I think what it's trying to do is to find good quality companies at an attractive price. So it basically ranks stocks on two criteria: what it calls earnings yield, which is not typically what you call like earnings yield, which is the PE, which is like on the other turned around, which is normally how you like associate like earnings yield with. But here it is EBIT, which is earnings before interest and tax by the market cap, and plus a long term and short term debt. So you're basically trying to rank companies based on like earnings by the market cap plus long term and short term debt, which is which is an interesting way of doing it, because you normally don't think of earnings yield in terms of including using short term and the long term debt. I mean, so it's an interesting way, but obviously this is trying to rank companies uh, based on valuation. So you look for companies which are like undervalued. and this and then the second criteria comes to companies uh, which are uh, which are growing well, which is what it's called return on invested capital, which is again not the typical formula. Return on invested capital, typically is the net profit plus uh, uh, by your by your by the equity in the company plus plus short-term and long-term debt. That's what you call return on invested capital. But here, um, it is actually EBIT, and it's um, I mean and you're uh, uh, dividing it by the uh, by the capital in the company plus plus the next fixed assets. Which is just meant to for you to brand companies which have a high uh, net profit margin, and compared to the assets in the company. So you are combining and driving these companies, uh, and when you rank the companies, you are taking the top tier companies, whether whether you're looking at the top 20 or 30 or 50 companies, and you're allocating capital into these companies, and the idea is that you don't rebalance them frequently. I think you should ideally rebalance it once the financial results are out, for the year. So for India, that would be March of the year ending 31st March. So ideally, results would come out by say by June. So ideally, you should rebalance it sometime in June or July, and then you let the and then you let the strategy run. Uh, because you just rebalance it once a year, and it's a strategy which doesn't take into account market conditions and like environments. I think um, it's a strategy which would take considerable amount of market volatility. I mean, it would. You're exposed because and so you would have to be prepared mentally for years of underperformance or like volatility. And it's something that you just have to go through with it. So you cannot like invest in the strategy and be sure that you earn like an outsized return this year. It is something that you have to stay for many years to see whether it's working or not. So for in that case, you have to be just disciplined about it. So both me and Sham actually have a version of a magic formula. This is Sham's performance. He's been tracking this strategy for the last 7 years, and as you can see, this strategy. If you see, over the last 7 years, it's done pretty well. It has outperformed the Nifty 50 and the mid cap index considerably. There's considerable outperformance in both the strategies. But then, if you just dive deeper into the numbers, you would find that the drawdowns, that is, the fall from the peak in this particular strategy is pretty sharp, and it's had a 4 to 5 year drawdown, which is still not recovered. I don't think most people would have the ability to withstand that amount of volatility, or that amount of ability to withstand like 3 or 4 years of losses and like underperformance. So it's definitely not for everyone. But on the flip side, if you just see how this particular strategy is done in the last 6 months, it's outperformed the benchmarks by again pretty good. So this strategy works in like particular market environments. And I think if you believe that you cannot time the markets, and you don't know what will come next, you just have to I mean, just stick with it as a part of a portfolio. I mean, do definitely cannot invest in this. Um, I mean, in the sense, a large chunk of your portfolio, because uh, it's not stable. I mean, it's not stable enough for you to generate returns year after year. But in certain periods or in certain market conditions, it does outperform. So you might have some strategies which might underperform in those circumstances, while this strategy outperforms. So you like overall you might not do badly. So this particular strategy fits into that role where it allows you to diversify into a strategy which might do well in a in the early stages of a recovery. And if you see, most value strategies do well in those market conditions, or at least traditionally have. As we dive deeper into the into the numbers, you can see again, if you see in the last 100 days, like you mentioned, the magic formula has done much better than than both Nifty and uh, has done much better than Nifty and at momentum and the mid cap index, and extremely well, which again, like, I mean, reinforces the point that it does well in in the early stages of a recovery. But then if you look at numbers from a much larger period of, say, the last 3 or like 5 years, it has underperformed considerably, like momentum or like even the Nifty. So it's not a strategy for everyone. It's definitely not a strategy for all market conditions, but it's something that does work in certain market environments, I think. Yeah. And the next part is Shah.
Yeah. So if the drawdowns of over 60% doesn't scare you off, here's a few more limitations of this strategy. One thing is, this is a relative value game, right? By relative value, I mean, when you rank anything, when you rank the universe, you're only trying to pick what is better, not what is best. So what happens in in an extreme bull market, right? So everything, all stocks go up, all valuations are sky high, everything is expensive. So at that point, if you rank stocks to find the cheapest, right, the ones with rock bottom distressed valuations, then what kind of stocks do you expect to find there? It's like the ultimate dross. It's stuff that don't even that investors don't even want to pick during a bull market. So if you invest in the in magic formula at in an environment where the market itself is extremely overvalued, then you end up with junk stocks. And this is one of the biggest reasons why the magic formula portfolio drew down by 60% after 2018. So 2017 saw extremely bullish conditions, especially in the mid cap and small cap space. Most stocks got extremely overvalued. And when you rebalance at that point in time, the kind of stocks you pick are stocks that are are disfavored even in a bull market. So when the market crashed for mid and small caps, these stocks got hammered way more than the general market. So it took another cycle, right? Another cycle of rebalancing for for the strategy to get back back in shape. Now here's a dilemma for investors, right? If you don't rebalance or stick to an annual rebalance, then your portfolio is kind of fragile, because when you rebalance into the fag end of a bull market, then you're going to have really bad stocks in your portfolio, and you have to wait for another year carrying that dead weight before you can rebalance into better stocks. But if you strictly say, okay, I don't want to take that risk, I'm going to rebalance every month, then the problem is you're constantly selling your winners and buying losers, which if you look at the statistics behind this sort of value portfolios, you have very few winners. So out of the 20 or 30 stocks you buy as part of this magic formula, maybe only 5 or 10 actually work out. The rest of them, are going to be ending the year in red. So it's absolutely essential for you to let the winners run. But what happens in a relative value game when you're ranking stocks is that the minute something becomes marginally more expensive, you're kicking it out. And you're not there to sort of reap the benefits of the market discovering that value and maybe overpricing it through the rest of the year. So if you rebalance infrequently, you have a fragile portfolio. If you rebalance too often, then you end up with constantly selling your winners and buying losers. So so this is something that that doesn't allow for easy answers. It is a question that investors need to ask themselves as to where the market is, how their portfolio is structured from a valuation point of view, and how do you reconcile the two, right? And you can play this game even with allocation towards the strategy. So as the market keeps getting expensive, you allocate less, and as the market itself reprices and becomes cheap, you allocate more, and then you rebalance. So it is a extremely tailored experience for for individual investors. So there's no magic formula for the magic formula. Having said that, the second problem is most of these balance sheet oriented strategies don't consider intangibles. By intangibles, things like patents, the value of patents on that a company holds, the amount of R&D spending it is doing. So if you're a software company, you cannot stop R&D spending, but that R&D is considered as an expense. It can't be capitalized, so it doesn't find its way on the asset side of the balance sheet. So these things kind of hamstring the so-called knowledge economy stocks that constantly need to be on the innovative side of things. And so that means that most of the stocks that get screened under magic formula are mostly your old economy stocks, like paper or plastics or oil and exploration, those kind of old economy stocks that are quote unquote non-ESG friendly in today's parlance. And this is something we need to keep at the back of our minds. Whether you like ESG or not, if that trend catches on, right, there's a large swath of stocks that that are not going to see incremental cash into them. So for example, right now, maybe globally, the amount of funds that have this ESG mandate, right, is maybe a few tens of billions, and that is already having an impact in the equity markets, and also making its presence felt in the bond markets. So in the bond market, if a large mandate like maybe the Harvard Endowment Fund or the Norwegian Sovereign Wealth Fund, which the Norwegian Wealth Fund manages almost $1 trillion. If they say that we don't want to invest in oil stocks, for example, or they don't want to invest in defense stocks because they're not ESG compliant, then that incremental dollar flows into the stocks, into these stocks go down. And not only that, the debt funding cost for that debt also goes up. So if they are, for example, if say Lockheed Martin is able to refinance its debt at 1%, Now, because of these ESG mandates, it moves the needle, and it goes to 1.01%. Right? It's just a small. You might think it's a small blip, but it affects their cost of funding to a very large extent, given how levered they are. So this further crimps cash flows, that is trickling down to the equity holders, and it might end up making a huge difference to into the eventual free cash flow profile of the company. So what happens is, because if this ESG mandate ends up becoming larger and larger and larger, then these so-called value stocks that are thrown up by quantitative value filters, including magic formula, I don't want to ding magic formula. It's a problem with all quantitative value filters. You might end up with a portfolio of stocks in mining, in steel production, in oil, in oil drilling and exploration, in in all these kind of stocks that are are in the ESG negative list, right? And you may have to wait for decades for the market to correct this mispricing, and it may or may not happen. So this might end up becoming a classic value trap if you're not careful. So I would I would say this is not a formula that can be applied blindly, and it has to be something that that requires you to make some quantitative some qualitative judgments regarding what goes into this portfolio. So you need to consciously be thinking of these points, right? What percentage of your portfolio should ideally be in magic formula? It's definitely not 100%, and I would recommend scaling your exposure based on overall market valuation. And given the way this strategy sort of outperforms during the beginning of a market, of a bull market, phase, maybe scale your your exposure based on the troughs in market sentiment. And regarding diversification, look, this strategy is technically ambivalent to market cap, but typically, if you look at the stocks that have been picked by the strategy, it's mostly mid caps and small caps. So you need to be aware of that. So if you already have a huge exposure to mid and small caps, then further layering in magic formula may not make much sense. And definitely, have a view on how we are going to take care of intangibles and this trend in ESG investing. So here's the thing, though, right? The book was published in 2005, and we are looking at 15 years since this strategy was out in the open. And when this book was written, and when the historical returns that were published, they were during a period where information was not that freely available. So Kishan recently mentioned, you can go to screener.in or you can go to moneycontrol.com and grab all this information. But if you think of this, back in 2005, that itself was a novelty. And most of the information was available only to professional investors. And if you and I had to get this stuff, you probably had to, drill through actual balance sheets and tabulate that information on Excel spreadsheets. And and I'm still talking about 2005, but he's the author has been using this strategy since the late 80s. And so that's like a big a leap of faith you need to take about information asymmetry back in the day, persisting through now. So that's one thing. So information is a lot more widely available now than when it was this strategy was tested. And number two was the period during which this strategy outperformed in the US was also an epic bull run. So comparing that with S&P 500 and saying that it outperformed is sort of comparing mid caps during 2017 and saying that look, my momentum mid cap portfolio outperformed Nifty 50. So yeah, if you're willing to ignore the fact that the whole mid and small cap universe was in the middle of a bull run, yeah, it looks like it did beat the large cap index, but the numbers that compares these to the mid and small cap universe in the US is not available at this point. So I would be curious, number one, to see how these numbers stacked up against a generic US mid cap index during that same time frame. So having given these caveats, how do you make this better, right? So one of the things you need to remember is the Flameback magic formula. Small case is not a completely mechanical system. It is definitely looking at the quality of the stocks that are going in, making sure that we are not buying junk stocks that everybody knows that there is a huge say governance problem, or there's probably a lawsuit pending or something like that, which is the reason why that stock is down in the first place. So that's number one. Number two is you need to know the base rates. One of the biggest problems is return on investment is a mean reverting series. There's no company in the world that can have above average return on investment for their industry unless they have somehow figured out how to game the system or how to redefine what the industry is. It is impossible for a specific company to have really large upside deviation in return of investment. So to give you an example, I think Kishan, we discussed the restaurant business, right?
Right.
So the restaurant business is, it's a very challenging, heavily competitive industry, and no barriers to entry. So anybody can set up a restaurant if they have the right, real estate. So what this means is your base rate for the industry as a whole is your net margin is around 5%. So at 5%, you're looking at a situation where if I screen these stocks and I end up with a company that is showing 20% return on investment, then I should not buy that stock, because theory says that that 20% next year is probably going to collapse down to 5% over the next few years at least. So you need to be always careful about what kind of base rate environment a particular company is working in, and these sort of margins, and so the so always dig below the numbers, see what's driving it. If it is indeed a game changer, right? So it is a restaurant that has figured something new out, and and you expect it to persist. That's when you add it to your portfolio. Don't blindly add something just because it has high ROI. Chances are it is going to revert to the mean.
Right.
And that's it from us. You can find us on Twitter. We have a newsletter going on Substack. It's called freefloat.substack.com. So please do go there and subscribe. And you can look at our different small cases on flameback.smallcase.com.
Yeah, and now if you guys have have some questions, you can ask us now.
Okay, I think the first question is from Prakash. He wants to know what's the universe of stocks considered while creating the portfolio, and how many stocks are part of the portfolio.
Right.
So, so I guess I'll take this question.
Yes. Yeah.
So the universe of stocks are anything that has the EQ series, which is basically liquid enough set of stocks. There are about 1,000 of them. So so that's the initial universe of stocks, and that is further filtered to make sure that we respect the market cap cutoff. So currently, we are looking at the top 800 stocks by market value that have the EQ series.
Right. So the next question is from Nikhil Lodi, who'd like ask, do we think the markets are like overvalued as of now? So this is always a extremely hard question to answer, because if you look at some traditional metrics, markets seem like overvalued. If you just look at C/P ratio, or if you just look at what economists say that the markets and the economy in general are in two directions. But if you take the whole context into consideration, which like interest rates, global flow of liquidity, which is again determined by the high level of like money supply in the global economy, then I mean the markets might not be overvalued. I mean it's a very hard question to answer, and I think most strategies or most investors are better off not trying to time the market. I think because this question can never be answered satisfactorily, because no one can predict what will happen either one day or or 1 year from now. It's an impossible task.
Right. So to add to Kishan's answer to whether markets are overvalued right now, that's, I would say, that's a kind of loaded question, because I would say yes, right now they are overvalued, but the problem really is overvalued compared to what? And if the market is putting a higher multiple to stocks right now, it is a combination of different things. So the primary driver is expectations. So will earnings kind of rise up enough to pull back the current valuation without a drop in prices? You should always ask yourself that questions. Will earnings grow fast enough for it to kind of normalize the PE ratio, for example, without bringing the P down, without bringing the numerator down? So
Yeah.
So that's a very tricky question, because there are a lot of things in play here. So one thing is reforms. We have all this bunch of PLI schemes, so on and so forth. So we don't know what the budget is going to bring. So the structure of the economy is definitely changing. The question is really, is it changing fast enough to have an impact on earnings? And that is a huge unknowable. So so there is a bit of kind of sticking your finger up in the wind and trying to see which way the wind is blowing aspect to this.
Right. The next question is from Karthik, Karthik Ganesan, who like wants to know what's the good time to like exit a small case out to book profit from? I mean, I would say that, I mean, the thing that we would recommend the most to people is to not invest in one strategy. Is to is to invest in multiple strategies. That way, one strategy might underperform and the other might outperform, and then overall you might have a return which is more stable over a period of time. So if you had invested say 10% of your strategy, um, of your larger portfolio into Magic Formula, with the 60% drawdown, you're still down. Uh, you know, uh, a small percentage. I mean, of your of your much larger portfolio. So it won't. You'll be down probably 6% of your overall portfolio. It's. It might seem a lot, but it's not something that you lose sleep over because the rest of the strategies would be outperforming at this point of time. We don't try to time the market because, as Sham will also tell you, it's very hard. Like in March, you would have had to have a lot of conviction in how the market will play out for you to go buy the magic formula at that point, because you would not have thought that the market would be at this level today. So it's very hard to time the market. I think it's much more easier just to follow a more disciplined strategy, which you're more likely to stick to.
Right.
Doing both ups and downs.
Right. So the next question is from Prakash again. Can we tweak the weightage of the relative value parameter to avoid junk stocks in peak bull markets? That is definitely something that is worth researching. But the problem is this. At the peak of the bull market, your entire portfolio is junk. So there's no avoiding it. So the only way you can sort of prevent yourself from buying into those stocks is to basically have a third cutoff, which is either looking at quality or looking at free cash flows of some sort. So to make sure that you're not buying into into junk. So I would not recommend playing around with the quote unquote magic formula ratios, but adding maybe a quality factor or a free cash flow factor to make it more robust.
Right. So the next question is from Nikhil Lodi again. Does ITC come under magic formula? So I think this is something that me and Sham end up speaking a lot about because it's like always in the air. So I think ITC might not be in like magic formula, but it surely would be. It sure can qualify. But again, this point that me and Sham brought on earlier, that if you just take ESG investing, and if that becomes a trend, then more and more fund managers would be asked to dump like ITC, because it would not fit into their criteria, including Indian funds like LIC and stuff, because you might have a lot of pressure on the government to adopt this style of investing. And the more pressure grows, not just like internationally, even domestically, more even like Indian individual investors would ask themselves whether they would like to stick to something like tobacco, which might be harmful. So it might be a value trap, like Sham said, that not just that it would not bring in new flow of capital into the stock, but it also might just it might lead to more outflows, which might lead to further like underperformance. I think right now, ITC trades at probably 20 times earnings, but maybe it should trade at 7 or 8 times earnings. Who's to say that can't happen. Most people expect, just because like Unilever which trades at 40 PE, or sorry, 60, 70 PE, and so like the ITC can can make up that gap between it, but it can also go the other way because of this trend like accelerating.
All right. So next one is a comment that I like to hear more often. It's from Ghana 15. Liked your straight and transparent talk. Well, thank you very much. Thanks for the kind words. Next question is from Pramod. What's the portfolio churn rate? What's the strategy to limit the downside risk? So the portfolio is is only rebalanced once a year. So there's not much of churn in it. So it's basically a buy and hold strategy. And before the change in long-term rates, the strategy was set up to rebalance every 366 days in order to make the tax outflow zero because of long-term capital gains tax was zero at some point. And the strategy to limit the downside. Look, our suggestion is make it part of a bigger portfolio, a larger portfolio scheme of things. Don't put all your investment capital in magic formula or, for example, momentum or anything else of that sort, because all strategies go through ebbs and flows. The best thing you can do to limit downside at a low cost is have like 10% of your equity portfolio in magic formula. So that way, when it does have drawdowns, you're not worried about your overall portfolio health, and you can stick through it and come out at the end of the tunnel with your portfolio intact. The other way to kind of reduce downside risk is combining this with with bonds. Just have some sort of a bond allocation within it. If you need comfort in allocating more towards this strategy, so that's one way to do it. Third is if you feel the market is too expensive and your barber and your from everybody from your barber down is talking about investing in stocks and how stocks only go up, then it's probably closer to the peak of the bull run. So I would scale down exposure to equities in general, and specifically magic formula strategies based on market sentiment. I'm sorry that none of these are foolproof or quantitative, but that's the nature of the market. So we kind of have to go with it.
Yeah. So the next question is from Sharat, who's asking, can the magic formula be applied to multi-bagger stocks? So the way the strategy is designed is that it, it's multi-bagger stocks which have increased by 100, 200, or 300%, will be ranked much lower in the rank of stocks in magic formula, only because the return on if you're taking the earnings by the market cap, so the stocks which have run up, that percentage is much lower for multi-bagger stocks. But yes, you can just have a universe of multi-bagger stocks, like stocks in the last 1 year or so, which has increased by 100% at least. You can just have a portfolio of those stocks, and you can apply the magic formula to it. That's something that I think Sham and I can test out, and we can have a newsletter sent out probably in the next few weeks to see if this might work just with multi-bagger stocks. Yeah, but but the way the strategy has been designed, the way the formula is been designed traditionally, it won't work. It can't. It's the next question is from Ghana. Ghana 15. While the strategy goes into certain market conditions, what is the complement strategy which can be used along with this when does not work for certain quarters, years. So I think complementary strategies. We speak of many people speak a lot about multi-factor portfolios. So your multi-factor portfolio is where your value, you have quality, you have low volatility, you have small size, your momentum, and momentum which is the most popular. Apart from this, if you have strategies which also, which is not for everyone, but if you have a long and short strategy, which balances all, your overall performance, along with some debt in the portfolio, which tries to augment the volatility. The overall the market volatility. I think that's a good portfolio, because then your social risk and your social return are diversified. One way to look at this is to see the correlation between each strategies. So you can have momentum, magic formula, a traditional value, and just see what's the correlation between each of these strategies. And if the correlation for each of these strategies is high, then then it's not providing you that diversification benefit. But if the correlation for if the strategy is is low, then then it makes sense for you to have the complementary strategies. At least then that some strategies work in certain conditions, some don't, and that might help you have a more stable portfolio. So I think having all of them makes sense, and also having a low volatility or not the factor, but having a strategy which is more stable through different market conditions, like a large cap momentum strategy. Where the drawdowns might be just more related to market, but overall, performs consistently, is a good complementary strategy to the magic formula.
Right. I think at this point we can end the Q&A session, Kishan.
Yeah. Yeah. All right. So yeah. So I think it's been a fun talk. I think both Sham and me have enjoyed the experience. We hope that we can do this again in the future. You can follow us on Flameback.small. You can find the strategies on flameback.smallcase.com. You can also subscribe to our newsletter at fifo.substack.com, where we actually test out and talk about different strategies almost every week. And yeah, if you're interested in in this, you'll be interested in that. So thank you.
Well, thank you guys. Thank you, Sham. Thank you, Kishan. It was a really great session about how magic formula works, and not just its advantages but also its limitations. So really love the session. Is there anything that you guys would like to add about the webinar, the session? How do you guys feel? Anything like that?
No, I think it went pretty well. Yeah, the question and answer session was a nice touch, I feel. So, good stuff.
Well, we're really happy to have you guys here, so that there's more interaction with people to know, because not a lot of us. Okay, for example, me myself, very layman in investing, does not know absolutely anything. But I think what you guys did here really helps, and all the explaining, so that for us people, it gives us an idea of what to do next, because we're absolute beginners and we have no idea. So it's sort of like a guidance. And thank you so much, Sham and Kishan, for having us on this talk. It was great having you guys here. Thank you.
It was a pleasure.
Yeah. Yeah.